In this video, traders, we've got 3 tick index trading strategies, one of my favorite market internals. Stay tuned. Hey traders, a warm welcome to you. All right, so 3 tick index trading strategies. Ultimately, tick index, I've done a video talking about what the whole thing is, but in a summary, number of stocks in the New York Stock Exchange trade on uptick minus a downtick. It's a good indicator to kind of see very short-term momentum. So for a day trade, if you're day trading ES, YM, possibly NQ, although this is New York Stock Exchange only, but you do have other tick indexes that are NASDAQ or only, NASDAQ or others, but this one seems to be the most useful. I believe it's the most useful. So when you start getting extreme moves, imagine what's actually happening underneath the hood, underneath the bonnet, is that it's actually everybody all of a sudden is buying at the market because there's the uptick. They're buying at the market. You can get extreme low readings on the tick. It means that everyone's selling at the market. Everyone's hitting that bid. And so theory being that, you know, spikes in price that are really spiking the tick, i.e. everyone's just having to hit the offer, could be a crescendo, could be exhaustion move on a very short-term basis. That's one of the things we'll look at in a second. So it's not a bad gauge. Generally, it's going to pivot, or it's going to oscillate between kind of minus 1,000 to plus 1,000, naught being neutral. 1,000s are considered an extreme reading. There are times where you might have a 1,200 reading on super extreme, but 1,000 is generally extreme. Kind of 500 is your normal, maybe 700, depending on the day type. So you can kind of see what happened during the day and how it moves. So I've got 3 broad strategies for you in this video. First one being the tick pullback to zero. I love this strategy. It's very, very useful and it can work very, very nicely. So let's say you're trading ES, YM, something like that. Let's say YM because if you're in the UK, you can spread bet it. It's very useful for you. So which is the Dow Cash, you spread betting the YM. So we've got a nice drive higher, good strength, good momentum, everything's working well. Starts to retrace down, ticks come back to the zero line because at the moment they've been a plus 500. Maybe they wouldn't have been up to 1,000, but they've been high. You know, they've been strong, and this is generally going to be strong to cause those ticks to be up, you know, above the 700 level, above the 500 level. So consistent high tick readings here, and then all of a sudden we get a pullback in price. Price pulls back to zero, and if you can imagine that, that means that everyone stopped hitting those offers, and we've gone a little bit neutral across all the stocks on the New York Stock Exchange. And then there's your buy point. So you're buying there as the price comes down through zero, expecting that the buying will resume again and you can scale out as the price pushes back up. And now listen, the whole point of this is to help you time your entry a little bit. So if it's coming down and pullbacks there and it's only down to kind of 500 ticks, it might help you hold on a little bit more and say, well, actually, I want to wait till it gets to zero, because once it gets to zero, then I want to pull the trigger because I feel that's like the spring contracting, ready to go again. So pulling back to zero is a really good one, especially if you've got strong momentum. You must have strong momentum on this. All right, second one, guys, is fading the extreme. So you've got extreme readings on the tick, which are plus 1,000, minus 1,000. It might be more than that, and also it's going to depend on the day type. Very often, when we're getting a good push up or a good push down, there will be one last big move in the ticks when everyone buys at the market or sells at the market, which can often indicate the end short term of that move. So you think about it, it makes perfect sense, right? Everyone's buying, then all of a sudden everyone just buys at the market. That causes the tick index reading to spike up because now there's a lot of stocks trading on uptick versus a downtick. We see that spike up, go plus 1,000. That could be either a short scalper's entry, hitting it there, or preferably you're already long, you're waiting for that extension in ticks to sell into. It's like, okay, there's the extension, there's a little stretch, bang, I'm going to sell into that. You know, that works very, very well for that scenario. When you're already in, let's say you're already in on this, you've got to pull back to zero, you've bought it, and then you're basically looking for a new high in ticks, starts to keep going. It helps you hold the position of it as well from a day trader's perspective. As those ticks suddenly spike up, a real spike in ticks, bang, you sell it to them, you're out. And very often, that might be the short-term high. Will it continue higher later? Quite possibly this is a very, very short-term tool. Okay, the third one, guys, is the changing trend. So you've got a chugging trend. Ticks have been kind of below, between 0 and let's say 600 all throughout the trend. It's pulled back a few times. Ticks haven't really gone below 0, but if they have, they've popped back up. Then all of a sudden, on the next pullback, this one here, ticks start to go below 0 and start to be kind of 0 to minus 500 and change the scenario. So that could be an indicator that the trend has changed. In actual fact, you're not going to be buying this pullback because this is more of a sustained move lower. Now people are selling programs are hitting the bids as opposed to buying programs hitting the offer. You're not talking extremes here, it's just a slight change in ticks. And actually one other thing you can do, guys, is you can put a moving average on your tick, a short-term moving average, so they kind of rise with the ticks, and as it crosses below 0, it might be an indicator that, hey, actually, you know, we've had quite a few tick readings below 0 now, moving average has crossed, maybe I should now either look for shorts or not look for longs. Maybe you want to then sell into any spike up in the ticks to get a spike up that goes kind of positive. You might want to end up shorting that for a mean reversion move back to whatever kind of average you've got there. Anyways, it's super, super flexible. A great thing to look at. It's on TradingView, put in tick. It's on there. It's on most of the other chart platforms as well. It's actually an index that's provided, I believe, by the New York Stock Exchange. So maybe you have to subscribe a couple of dollars, I think, to it. I'm not sure, but nevertheless, there might be a synthetic one out there. But it's tick index is what you want, and you want to see it kind of looks like this, where you've got you know, a 0 reading here, 1,000 reading here, a minus 1,000 here, and price will kind of sit, you know, like this in between. This is what it will kind of look like. And you really want to have bars, because you don't need candles, you should have bars, and each bar will be doing this kind of stuff. So if you see that, that's the tick index, and it's well worth looking into, especially if you're day trading the US indices. Take care, guys, whatever you're doing. Bye-bye.